Hey everyone, welcome to today's Explainer. We are jumping right into a really fascinating piece of research that recently dropped in Presidia Computer Science. A team of researchers basically built a hybrid machine learning trading model from the ground up. And honestly, it offers a completely fresh perspective on algorithmic trading. So we're going to break down exactly how they built it, how it works under the hood, and of course, the results it cranked out. I mean, it's the ultimate financial question, right? Can an algorithm actually predict the stock market? Especially today. If you've been watching the post-COVID financial markets, you know they've been incredibly chaotic. We're talking about stock prices swinging wildly based on a single random tweet or a sudden news headline. Traditional forecasting models have really struggled to keep up with this kind of dynamic, non-stationary environment. So researchers are now turning to advanced machine learning to see if, a machine can finally make sense of all this madness. Okay, let's dive into this. The whole reason algorithmic models are taking over the financial sector really boils down to a few core differences highlighted in our source text. Look, human traders, no matter how disciplined they are fundamentally emotional creatures. And we just have a very limited capacity for processing data. We can only read so many news articles or analyze so many charts at once, right? Algorithmic AI trading, on the other hand, is entirely emotionless. It can ingest massive, massive amounts of data, from price movements to global news, in literal fractions of a second. It just adapts dynamically to market shifts without ever second-guessing itself. To make sense of how this model pulled off its results, here is our roadmap for today. We're going to cover 1. The AI revolution, 2. Building the hybrid model, 3. Reading the market's mood, 4. The risk management secret, and 5. AI versus the market. All right, let's kick things off with Section 1, the AI revolution. So the researchers behind this paper realized something crucial. Relying on just one type of data simply isn't enough anymore. They designed a hybrid approach, which is kind of like baking the perfect recipe. Your base is the technical indicators. That's the raw math, the past stock prices, the momentum. Then you add the spice, which is sentiment analysis, using AI to read the news and actually gauge how people are feeling. But the absolute most important part, the thing that stops your whole portfolio from burning to a crisp, is the oven control, which is a structured risk management protocol. You absolutely need all three to make this work. Moving right along to Section 2, building the hybrid model. Let's look at the architecture. Picture this. You are the trading algorithm. Your day starts just before the 9:30 a.m. market open, let's say 9:15 a.m. First thing you do is fetch the morning data, grabbing all the open, high, low, close, and volume stats, right alongside the latest morning news headlines. Second, you calculate those technical indicators like moving averages while simultaneously scoring the sentiment of the news. Third, you jam all this into a single feature vector, feed it straight into your trained machine learning model, and you predict the trend. Finally, based on those signals, you execute your trades the exact second the opening bell rings. It's a busy morning. And this brilliantly illustrates that exact process from the researchers. Notice those dual pipelines on the left? You've got the Y Finance database feeding in the hard market data and the Alpaca database feeding in the news headlines. They get processed in parallel, combined right in the middle during feature engineering, and then pushed into the model training and backtesting phases on the right. It's honestly just a masterclass in structured data architecture. Okay, on to Section 3, reading the market's mood. Let's talk about the spice. To actually do this sentiment analysis, the researchers utilized something called Finbert. Now, Finbert is a specialized large language model. Think of it kind of like a cousin to ChatGPT, but it was explicitly trained on financial text. Using the Alpaca API, the system pulls in daily news headlines and just feeds them right into Finbert. The AI reads the text and classifies the overall market sentiment as positive, neutral, or negative. And if there happens to be no news on a given day, it just defaults to a neutral score of 0. This is totally a game changer because it allows the trading model to actually quantify human emotion and expectation. Which brings us to Section 4, and this is absolutely crucial, the risk management secret. See, the researchers identified a massive gap in a lot of current AI trading studies. They often completely ignore what happens when the AI is just flat out wrong. I want to read this direct quote from the study because it hits the nail on the head. Since markets are unpredictable, there is always a chance that they might trend in both positive as well as negative directions, even with the strongest confirmation. The true secret ingredient here isn't just brilliant prediction, it's relentless protection. So, what were the specific rules they put in place? Well, they implemented a strict 2.4% maximum stop-loss threshold. Basically, if a trade goes against the AI by 2.4%, the system automatically pulls the plug. It takes a tiny loss, which prevents a catastrophic crash. They also used dynamic position sizing based on a starting equity of $10,000, which ensures the algorithm never risks too much capital on any single trade. Like we said earlier, this is our oven temperature control, keeping the whole operation from burning down. Now, to measure if this risk management actually worked, the researchers relied on the Sharpe ratio. In the finance world, you can't just look at raw profit, right? You have to look at how much risk you actually took to get that profit. The Sharpe ratio is essentially your risk to reward scoreboard. It measures the excess return a portfolio earns for every single unit of volatility it endures. A higher Sharpe ratio means you're making more money safely rather than just getting lucky on some wild gambles. If you're ever building your own portfolio, this is literally the metric you should care about most. And that leads us to the grand finale, Section 5, AI versus the market. To find the absolute best approach, the researchers tested a staggering 468 different machine learning configurations. First off, let's just look at raw predictive accuracy. Out of the 12 different architectures tested, ensemble methods completely dominated. AdaBoost led the pack with an incredible 87% average accuracy in predicting the market trend. It was closely followed by XGBoost at 86.9% and logistic regression at 86.3%. These algorithms proved exceptionally good at finding the real signal in all that noise of combined technical and sentiment data. Now, accuracy is great and all, but let's move to and see how this builds into actual real-world profits. The ultimate benchmark for any investor is the traditional buy-and-hold strategy. So how did this actively trading AI compare to a passive human investor over a portfolio of 10 major tech stocks like Apple and Tesla? Well, here's our baseline. If a traditional investor just bought and held those 10 tech stocks, they would have seen a portfolio return of roughly 499%. I mean, that is a fantastic return by pretty much any metric. But wait until you see what the algorithms did. Boom! The raw AI models, trading dynamically based on those technical indicators and the Finbert sentiment analysis, but crucially, without the risk management rules applied, generated a staggering 1,441.56% total return. That's nearly triple the performance of simply holding the stocks. The AI essentially proved that actively reading sentiment and momentum yields massive edges. But here is the grand twist of the whole study. When the researchers applied that simple, unsexy 2.4% stop-loss risk management rule to those best-performing models, the final portfolio return shot up to over 1,547%. By occasionally taking those small, controlled losses, the system completely avoided major drawdowns and actually compounded its wealth significantly faster than the raw AI. Literally, protection generated more profit. So the crucial point is that this strategy wasn't just some lucky fluke on a single stock. It worked across the board. Look at NVIDIA. The buy and hold strategy made roughly 299%, but the risk-managed AI, using a logistic regression model, pulled in 574%. For Meta, buy and hold yielded about 94%, while the AI, utilizing a support vector machine, delivered an astonishing 354%. And maybe the most important part, the Sharpe ratios on these risk-managed returns were significantly higher. That proves these massive gains were achieved more safely and with way less volatility than the raw trading models. Now, what's really interesting about this slide is the visual relationship between accuracy and return here. Generally, you can see a positive correlation. Models further to the right tend to be higher up. But it's not perfectly linear, right? Some models, like Random Forest, had moderate accuracy but still achieved superb returns. It visually cements the core thesis of the paper. Raw predictive power is great, but balancing that prediction with strict, uncompromising financial risk controls is the true path to generating sustained wealth. Which leaves us with a pretty profound thought to end on today. This study practically proves that by combining technical data, AI-driven sentiment analysis, and strict risk management, algorithms can decisively crush traditional market strategies. So I want to leave you with this. If machines can now read the morning news, accurately predict market trends, and flawlessly manage their own risk, what does the future of human investing actually look like? Are we entering an era where the human trader is just totally obsolete? It's a fascinating question. Thank you so much for joining me on this explainer. I hope it really helps structure your understanding of where algorithmic trading is heading. And I'll definitely catch you on the next one.